Have you ever wondered how, sweeping government healthcare laws actually impact the bottom line of the massive companies that insure us? Like the real mechanics of it.
Oh, it is a fascinating translation process to watch. You take these massive bills passed in Washington and you watch them trickle down into very specific corporate balance sheets.
Right. And that is exactly our mission for today's deep dive. We are looking at the business of healthcare, specifically unpacking Centene Corporation's Q1 2026 financial results.
Yeah, and our sources today are the official Q1 2026 SEC Form 10Q filing from Centene and their earnings press release. Both of these dropped on April 28, 2026.
Okay, let's unpack this because the goal here is to decode these incredibly dense, frankly, overwhelming financial documents, right? To
Mhm.
see how major new legislation is reshaping the whole insurance landscape.
Exactly. We are looking at the recently passed One Big Beautiful Bill Act, which people call OBBA, and of course the Inflation Reduction Act.
Yeah, right. And how these laws are changing who gets covered and paradoxically driving record profits. Because the data in this first quarter report is genuinely surprising.
It really is. It defies traditional business logic at first glance.
It totally does. Look at this contradiction. Centene lost 1.7 million managed care members compared to last year. That is a 6% drop, leaving them with 26.3 million members.
Right.
But total revenues actually grew by 7%, up to nearly $50 billion for the quarter. And they just crushed their adjusted diluted earnings per share expectations by about 50 cents. They hit $3.37.
Which is a massive beat for them.
It's wild. I mean, it's like a restaurant losing a quarter of its regular diners, but somehow reporting record profits for the quarter. How does losing 1.7 million customers result in making more money?
Well, the restaurant analogy holds up perfectly if you actually look at what those remaining diners are ordering and, who is picking up the check.
Okay, I like where this is going.
Yeah, so the revenue bump is driven by three main things. First, you have these state-directed payments. These are essentially pass-through funds from the state. Second, they secured significant rate increases to address medical trends in their Medicaid business.
Right, they negotiated higher rates.
Exactly. And the third piece is massive premium yield and membership growth in their Medicare prescription drug plan business. That specific segment grew to 8.78 million members.
Okay, so they made more money per person and they expanded heavily into Medicare. But we really need to figure out why those 1.7 million people left in the first place. Because to understand that, we have to look closely at a massive shift in government Medicaid policy, right?
Yeah, you have to look at the Medicaid segment. That is where the drop overwhelmingly happened. Their Medicaid membership fell to 12.4 million.
Wow. Okay.
And this exodus is due to two things. First, the post-pandemic eligibility redeterminations. Basically, states waking up and checking if people still qualify.
The great unwinding.
Exactly. But the second factor is the implementation of the July 2025 One Big Beautiful Bill Act, or OBBA.
Let's break down OBBA impartially because it really changed the rules of the game for the safety net.
It did. The law requires work or community engagement specifically for Medicaid expansion members. It also forces much more frequent eligibility redeterminations by the states, and it introduces copays.
And it cuts certain state subsidies, right? The filing mentions New York's Essential Plan 5. That was a plan that subsidized people sitting at 200 to 250% of the poverty line.
Yeah, OBBA forced the phase out of that specific funding. So when you introduce those kinds of administrative hurdles, the paperwork, the work checks, you inevitably see a drop-off.
Wait, hold on. If OBBA and these redeterminations mean healthier people are dropping off the rolls because, healthy people might just not fill out the paperwork, leaving a pool of members with higher overall morbidity who cost more to treat, shouldn't that severely hurt Centene's bottom line?
You would think so, but what's fascinating here is how they managed it actuarially. Centene anticipated this. They proactively worked with their state partners to establish new premium rates.
Before the contract's renewed.
Yes. They established rates that accurately match the higher acuity, the sickness level of the remaining population. Because the state is paying higher premiums per person for that sicker pool, the overall revenue goes up even as the headcount goes down.
That is incredible. They basically proved to the state, hey, the people left on our plans are sicker, so you need to pay us more to cover them.
Exactly. But it isn't just Medicaid that OBBA is transforming. The legislation is also fundamentally changing how Americans buy private insurance on the marketplace. It forced Centene to rethink its entire commercial pricing strategy.
Right, because the marketplace honor system is basically over.
Yeah, it really is. Let's look at the marketplace numbers. Their membership dropped there, too, down to 3.58 million.
And this is because of the expiration of the enhanced advance premium tax credits, right? Plus, the new marketplace integrity and affordability final rule and the OBBBA restrictions.
Correct. The big shift happened on January 1st, 2026. Now, individuals who misestimate their projected income have to reimburse the IRS for the full amount of any excess tax credit.
The full amount.
The full amount. Furthermore, the exchanges can no longer accept self-attestation of income if the IRS can't verify it.
So basically, the days of the honor system are over. It's the IRS saying, no more guessing your income, show the receipts, or you're paying it all back.
Exactly.
So what does this all mean for the actual people buying insurance?
Well, because subsidies are stricter and the penalty for guessing wrong is a massive tax bill, healthier people are opting out. They just drop coverage.
Leaving a higher concentration of sicker members.
Yes, particularly in the silver tier plans. But again, Centene anticipated this. They enacted corrective pricing actions covering 95% of their marketplace membership for 2026. They prioritized profitable margins over raw membership numbers.
They raised prices knowing they'd lose people, but the ones who stayed would pay enough to make it work. I mean, predicting member health and behavior like that is risky, but honestly, looking at the filing, it's nothing compared to the massive financial risk Centene just absorbed on the Medicare side due to the Inflation Reduction Act.
Oh, absolutely. The Inflation Reduction Act's 2026 impact on Medicare Part D is massive. The law eliminates the coverage gap entirely.
Right.
And it caps a member's annual out-of-pocket drug costs at $2,100.
Which is great for a senior's budget, obviously. But the cost of those drugs doesn't just vanish.
No, it legally shifted a massive portion of the total Part D benefit costs away from the members and straight onto the insurance plans. And making matters tighter, CMS, the Centers for Medicare and Medicaid Services, eliminated the narrowed risk corridors for 2026.
Which basically means Centene is absorbing standard financial risk without the federal safety nets that existed back in 2025. They are out there without a net.
Exactly. So to manage this huge cash flow risk, Centene did something highly specific in March 2026.
This was the $1 billion shuffle, right?
Yeah. They took $1 billion of the money the government owes them for 2025, Part D risk sharing, and they sold it to a third-party purchaser at a slight discount. They took that $970 million in instant cash and immediately used it to pay off $1 billion of their own senior notes, their debt, that wasn't even due until 2027.
That sounds wild. That's like me taking my future paycheck, selling it to a cash advance spot at a discount, just so I can instantly pay off my credit card today. Why take the $30 million loss on the sale?
It sounds counterintuitive, but it was a strategic deleveraging move. By doing that, they reduced their debt-to-capitalization ratio from 46.5% down to 43.2% in just 3 months.
Oh, that's a fast drop.
Yeah, and it vastly improves their long-term financial flexibility in a very volatile regulatory environment.
Okay, I get it. Buying peace of mind. But, clever financial accounting on Wall Street only works if the company is actually managing the real-world cost of healthcare on Main Street.
Which brings us to the health benefits ratio, the HBR. This is a key industry metric showing how much of premium revenue actually goes to paying for medical care.
Right, and Centene actually lowered theirs to 87.3%. And they also lowered their selling general and administrative expense ratio, their corporate overhead, down to 7.6%.
Which is very lean.
Extremely lean.
Yeah.
But here's where it gets really interesting. When you look at how they are managing these medical costs, it's not just denying claims. They're actually funding hyperlocal community interventions.
Yeah, the Q1 initiatives are quite revealing.
They highlight the WellCare Food is Medicine program, providing home-delivered meals for diabetics in rural Kentucky. They have a provider accessibility initiative funding wheelchair ramps and ADA doors in Ohio. And, my favorite, they are investing in 244 affordable housing units in Winston-Salem.
It's a very different approach.
But, to you and me, buying groceries and building apartments looks like charity. How does this actually reduce an insurance company's medical costs?
Well, if we connect this to the bigger picture, it's all about social determinants of health.
Okay.
Spending $100 on medically tailored meals isn't charity if it prevents a $10,000 emergency room visit for diabetic shock. It's a very calculated, upfront investment that directly lowers the HBR over time.
You spend a little on food to save a fortune on a hospital stay. That makes total sense. And honestly, these operational wins are exactly why Centene so confidently raised their 2026 earnings guidance.
They did. They raised their 2026 premium and service revenue guidance by a full $1 billion.
Which puts them at $175 billion.
Right. And they increased their adjusted EPS floor to greater than $3.40.
But, a close look at the legal disclosures in that 10Q reveals It isn't entirely smooth sailing. The guidance is up, but there are clouds on the horizon.
There always are. The SEC filing impartially outlines several contingencies. Specifically, there's the July 2025 federal securities class action lawsuit, Brock Lundstrom v. Centene Corp.
And what's the claim there?
The lawsuit alleges executives made false and misleading statements regarding their 2025 earnings guidance, and that has sparked 5 subsequent derivative lawsuits.
Wow.
Now, the company vigorously denies any wrongdoing. These types of legal clouds are standard risks listed in 10Q filings to protect the company.
Standard cover your bases stuff.
Exactly. But they represent the very real pressure executives face to perfectly predict earnings in an incredibly unpredictable regulatory environment.
It's basically an impossible job. You have to predict exactly how sick people will be and what the IRS will do years in advance.
Right.
So, tying this all together, understanding these dense SEC filings isn't just about stock prices, is it? It's the truest reflection of how Washington legislation, like OBBA and the IRA, actually trickles down to corporate balance sheets and eventually to the premiums you pay and the care you receive.
Absolutely. And it really leaves you with something to ponder. If lowering the health benefits ratio means insurance companies are now acting as local grocers, landlords, and accessibility contractors just to keep you out of the hospital,
Right.
what does the health insurance company of the 2030s look like? Will they cease to be just financial risk managers and instead become total life management conglomerates?
That is a wild thought. Managing every aspect of your life just to keep their claims down, that is something to think about. Thanks for taking this deep dive with us.